Thank you for taking a moment to be with us. You are attending presentation training. We are talking about what investors really want to hear. Now, this is important because why you go out and start your business and why an investor chooses to invest in your business are actually different. And so a lot of the hangups that entrepreneurs get into sometimes is that they're so passionate about why they started it and why they're doing it that they miss the point of why I'm going to choose to actually put my dollars, my hard-earned money into your company and support you in that effort going forward. So I'm here to help kind of bridge that gap today and hopefully provide some insight as to what we are looking for. A little bit about myself and who I am. My name is Brianna McDonald. I'm the president for Keiretsu Forum Northwest and Rockies. I've been angel investing for 15 years. I wrote my first check at 26 into a food company. I have not invested in a food company since. I did get a return on that investment, but also learned a lot of lessons along the way. I have about 25 companies in our personal portfolio, and since becoming president in 2018 have helped facilitate about 200 million to about 250 companies. So we're very active at what we do here in this region, supporting entrepreneurs, making sure they get the resources that they need to get to the next level. Keiretsu Forum is the world's largest investment network. We have over 55 chapters, 4 continents, 26 countries. We have over 3,000 members. We work together, and we have funded more than 1,100 companies to date. We have been the most active in the world the last 6 years running amongst different stages, and we sit amongst some behemoths up there in the marketplace. As you see, there's many venture capital firms. We are the only investment group that is actually listed in these top rankings of PitchBook, and it has shifted and moved over the years. Early on, back in 2015 or 2014, when we first made these charts, we were number 1 in seed. Now we're early stage and late stage, and we continue to move up those ranks in terms of the companies that we fund. What we really help to fill is this gap. And it's really, it's not even so much a gap, it's more of where the fork in the road occurs for you as an entrepreneur as you continue to think about your capitalization plan, your fundraising plan, what you need to do to get to those next inflection points to get that increase in valuation. We find that when companies, they do a lot of early stage funding, friends and family, seed round, they find those early check writers. There's a lot of local angel groups in the system that do all of those early things. And then we fund really Series A and beyond. And so it's this gap, usually companies doing a bridge to a Series A, maybe a 500,000 in terms of a note, up to 5 million or even 10 million in funding. But what happens here is it usually branches off, and you have either companies go the VC route at this point, or they stick with the private investment route, sticking with family offices, private investors. There's pros and cons to both. The data here is a little bit old, but it is still relevant. And I think these stats are still really true in terms of the delta between what private investors fund and what venture capital funds. So in 2018, you can see venture capital put 130 billion into early stage companies, which is a lot of money, but it was less than 9,000 deals. Conversely, the private investors put about 23 million into 66,000 deals. So there's a big difference between really looking at funding those companies that are earners, that earn and build revenue and build their company progress, and the burners and the companies that like to just burn through cash as quick as possible and drive up the valuation. Whatever company you are, it's up for you to decide, but that's a bit about what we feel here within the Keiretsu network. We do have a very structured process that our companies move through to be able to receive funding. It starts off usually with an application, emailing our entrepreneur director, Juan Harango, and he helps to sift through the deals, see if there's a there, get some off to committees for some deep look into opportunities or internal review of those companies. We have 30 to 50 companies reach out per month. Then we move to deal screening. And honestly, this should say 5 to 7. Since moving to Zoom, it's 5 to 7 companies that come to deal screening. So of all of those companies that present, only a select few end up moving on to that process. And our investors choose to invite, delay, or deny. And then we have our forum meetings, which occur once a month. Our companies present in 6 different regions over the course of 4 days. And we put them in front of as many investors as possible. And from there, if they're building due diligence teams, they'll move into the next stage of the process. If they're able to get their due diligence complete and Keiretsu investors on board, they can apply to the Keiretsu Capital Fund for a top-up of their round. The biggest thing I want to point to this investment process is you are cultivating relationships. So how you show up as a CEO, how you communicate, how you answer questions, how you get investors the proper materials they need to review in order to make a decision, all shows us as investors how you are going to show up to our investment and how you're going to work through that. Companies that think this process is going to be done for them are typically not successful because that's not what they do. Our investors are not investing in us. They're investing in you. They already follow us, they work with us, and they support us in the facilitation. So that's the biggest thing I want to highlight about the investment process today. So working through creating a fundable pitch, and hint, it's not about raising capital. Your pitch isn't what is going to get those checks in the door. The pitch is what gets you that next phone call, that next Zoom call, that next coffee meeting. We did just launch a poll, so if you could let me know where kind of your thoughts are, we'll leave this poll up through the duration of the meeting. Before you leave today, if you could click on polls, we will then be able to take that information and deal with it accordingly. But your pitch is meant to generate interest. It's meant to talk about things at a 50,000-foot level, not to dive into the weeds. You only have a finite amount of time in front of these investors to capture their attention. For them to be able to dive in deeper on an hour-long call, you can do just more. I would like to ask you, as we move through the decks today, as we move through this presentation itself, I would like to know what sticks out most for you. Is it the pictures? What is it? What draws you in to what is being said? And really taking from that self-assessment of thinking about what draws you in and then applying that to your own pitch. All right, so the first thing you need to do is know your audience, and you need to know who you're getting in front of. Is it an investment group? Is it an individual investor? You know, who are you presenting to? Do they have a special expertise? What else are you looking for? I would just like to cue you in. We are investors. So our goal in everything that we do, even though we're working to help you and do other things here, the end goal is to make money. We are here to put our money into your business to get a return. This is not charity. This is not me just giving you money. This is me coming in and really for a long period of time being engaged with you, helping you to grow this business and get to where it needs to go. And the first thing you really need to cultivate when you're talking to me is your purpose. You could also exchange the word purpose with passion. It is focused. It is your gasoline. It is what gets you up early in the morning. It is what keeps you up late at night working. It is what helps you to drive forward in really what is this very hard journey as an entrepreneur. This is not for the faint of heart, what you've signed up for. This is hard stuff. And there's a lot of trials, tribulations, learning, and we just need to know how committed you are to this. And that comes through in a multitude of ways, which I'll get through in a moment. The next thing that you need to do with your pitch is eliminate red flags. I'm always one for calling out the elephant in the room. The last thing you want to do is have an investor give you a gotcha question because you're trying to skirt around an answer. If you've got a problem and you don't know the answer to it, be upfront about that. We understand as investors, and especially professional investors who have been doing this a long time, your business isn't perfect. If it was perfect, it would be on the public markets and worth billions of dollars, but it's not. You have a lot more to do. You have a lot to work on, and we're here to help and support. But you've got to call that stuff out up front. So eliminating the red flags is really important. It helps me to build trust, understand where you are and where you're going and the resources that you need support and help with, and if I can actually help contribute to that tonight. The next thing is demonstrating competency. We need to know that you know this. Why are you the person to lead the way? Why are you the person to build the team? At the end of the day, we're investing in you. Your inability to execute will leave my investment to zero. I will get no return. And neither will you for the most part. So how do you do that? How do you demonstrate competency? And lastly, if you're able to do those things and work through the process, you will be successful in raising capital to be able to get to the next stage, hit those milestones, and hopefully hit that next inflection point. So a few things about creating your pitch deck. And I want to caveat this with, things in this area are never black and white. There's actually a tremendous amount of gray that goes on. So this is kind of the formula I recommend. I put numbers and slides next to them to try and help create a framework. But if you can get through 25 slides in 7 minutes, by golly, you go ahead and do that. If you want to be able to, move through more slides than this or less slides than this, but keeping in mind the flow matters. I like to think about this like really good character development. If you ever think about Game of Thrones or Lord of the Rings, over a period of time, everything builds and grows on one another. Also, we have attention span of gnats. We can thank for the fact that we have ADD from Apple, but I don't remember all the most important stuff. If you put that at the front of the deck, I don't remember it by the end. I just don't. There's too many things I'm trying to process and think through and look at and read as you're talking, and you want me to be able to stay focused. So the most important slides come at the end of the deck, which also can create a problem for some entrepreneurs because you like to talk about the problem so much that you end up eating up most of your time and you end up rushing through those last slides. So it's really about understanding your cadence, your timing, how you move through the slides at a good pace, and be able to save a majority amount of your time for the end of the deck. And as we move through this training today, you will see the most amount of time I spend on the slides are at the end as well. So it very much mirrors that. So let's get things kicked off here and move into creating your pitch deck and really how to talk about things in a way an investor understands. Now, over 15 years of sitting in deal screening, I've seen some really, really awful pitches where you're mind boggled the whole way through the pitch. So what is your product and what is your business? And I'm sorry, are you selling something here? Like, what are you actually talking about to me? And so the overview slide or the title slide is probably the most important slide of the deck. It gives me the foundation as an investor of what I'm about to listen to. So there will be no questions about who you are and why you're standing in front of me, about what your company is or what it does, and why you're standing here. So, hi, my name is Brianna McDonald. I'm CEO of a B2B SaaS company. I'm here today raising $500,000 on a convertible note to get to my Series A. Boom. I now know as an investor exactly what I am listening to. I know how to think about different things when they get to the market slide. I know how much money you're raising that I can assess as you go through your deck. I don't need this to be long. I don't need this to go on for hours. I just need it to be short and sweet and to the point as you get to this slide, the problem slide. And the problem slide is probably the biggest problem for entrepreneurs, as I was stating. You should not spend a lot of time here. I will be really honest with you. I could give a crap what the problem is. And chances are I probably already know what the problem is. I understand you as the entrepreneur are really passionate about this problem and solving this problem. I get it. This is what, keeps you going every single day. But for me, I'm not investing in the problem. I'm investing in the solution. So what I need from you here is, a nice picture that can draw me in to the frustration, to the challenge. This is a woman who has listened to so many presentations that have talked so much about the problem that she's about to lose her mind. So please don't, do that. Just let me know that there's a problem that you're solving in the marketplace. Draw me into the presentation. The pictures do that. Words do not. We are emotional human beings, and this is how we work. Short, sweet, really no more than 30 seconds, maybe a minute if it's a little bit more of a nuanced business that you're working in. But that's valuable real estate that you're giving up for the solution down the road for the rest of the slides that you need to get into. Then we get into the solution. Now, this is something I want to hear about. This may take a few slides. That's okay. What is your solution? Why is it better? How is it solving this current market problem? Why are people going to end up choosing this over you or over the other products that are in the marketplace? How does it work better? Show me pictures, show me examples, give me an understanding, show me happy people using the product, whatever it might be. And this can be done from, medical devices to technology solutions. to consumer products. The only thing that it really can't probably be done with is with pharmaceuticals. That's a little bit more nuanced. But give me some slides, give me some content here on how your solution works and why I should really consider this and why it's novel. As many entrepreneurs say, wow, it's going to revolutionize the industry. And so as you move through your solution, you get to your addressable market. So this for me is a red flag slide. I should really put a red flag on this slide. So few things about the addressable market. One is if you come up to your pitch and you tell me that your market is like 40 billion people and you like leave it at that as you go into your go-to-market strategy, I'll pretty much write you off. There's no way as a small entrepreneur that you can tackle a $40 billion market. I'm sorry. There's just not. So what I want to see is an understanding of your total addressable market. And then I want to see it broken down from there and really pulling out your target market and where you're starting. What is that low-hanging fruit? How are you going to bring on those first sales? What are you going to do? For me, the market slide ties directly to the financial projection slide. Knowing that the financial projection slide are just projections, your market is how you get there. And it demonstrates your ability to scale. It demonstrates that you've been thoughtful in your approach on how you're going to move into your go-to-market strategy and your business model. It shows me that you have concretely built out a plan on how you're going to get there versus just being able to boil the ocean. And so this slide is really important. I like to see it in pictures. I do not like to see it written out in words. One thing I just want to highlight with words is that we as humans can really only focus on one thing at a time. So if you want me to read your slide deck, that's great. You can pretty much assure I'm not going to listen to anything you're going to be saying because I'm going to be processing what I am reading. And so as you think about, the fewer words on slides is better. Your pitch and who you are is what's going to come through. Now, if you have a deck that you're just sending to investors that they're going to read and you're not pitching, by all means, have that deck too. But do not do that in front of a large audience. So then we get into your go-to-market. And this really comprises of many different things. This should be a few slides that you actually move through. It's your business model. It talks about your COGS. It talks about the market research you've done and how you've been thoughtful about building your product. It talks to you about current customers that you currently have and in the pipeline going forward. Are there different verticals that you're going to be moving into? What is your sales strategy? What is your plan to grow? I cannot stress the importance of these slides because for us as investors and for what we fund at this stage, this is what we're funding. This is what we're giving our capital to right here is this go-to-market. It's the business model. It's understanding all of this. And so if you kind of skirt over it, well, I've got this great product and it's done and we're gonna manufacture it and then we're gonna use our team to sell it. Okay, well that's lovely. I need a whole bunch filled in there. Where are you manufacturing it? How much are you selling it for? How much does it cost you to make it? What is the retail price going to be? Are you going to be using online marketing? Are you going to be building a sales team? If you are going to be building a sales team, then who's going to be heading up that sales team and why are they the person to do it? And why have these customers signed on? And how many LOIs do you have in place? And why are they important? And could they potentially buy you down the road? I mean, that it goes on and on and on in this portion of your pitch. You cannot leave this stuff out. This is what investors fund, is really you being able to grow your business, get that traction, hit those key milestones that are super important for you to be proving it out, to get that next evaluation inflection point, which is what we're looking for a return on our investment. So as you move through these slides, think about your go-to-market and how that applies. Now with life science companies, it's a little bit different. A little bit more of what you end up talking about here is regulatory process, building out of the product, where you're going to be manufacturing, if they're iOS certified, being able to go through those different stages, who's going to sell it? Is there different hospitals that are going to be adopting it? Do you have trials set in certain places? Are you having peer-to-peer reviews? So really thinking about those different items as well, because that really fits more of your go-to-market, knowing that revenue isn't going to be the lead driver in that. And then we move into your barriers to entry. Now, this slide in particular, the picture really speaks for itself. You have a moat, do you have IP, do you have trade secrets? I really don't want you to spend a lot of time on this slide. In general, investors will always ask about your IP in Q&A, and you can touch on it. You can let people know that it's there. You can always revisit it in questions, but keeping that in mind, it should be there. It should be there for you to refer to later on, but you should really keep moving through your pitch and go on to the next slide, which is competition. So this is where things start getting a little bit longer. Competition is really important. I did start and fail a business at one point in time. It did not cost too much. I will say I learned a tremendous amount. So I understand what it's like to be in your shoes, to be pitching and moving through this process. I was terrified of my competition, and it's because I had no barriers to entry. And so any big company at the drop of a dime could change their business model and basically take me out. And so that was very nerve-wracking. But at the same time, moving through and learning about my competition, I began to understand how important competition is. And it's important for more reasons than the fact that they're doing something similar to what I'm doing. It's important for me. One, they've already paved the way. I can learn from their mistakes. Now, if you're a trailblazer out there, God bless you. It's really hard to be a trailblazer. It's really hard to be the first mover in the market. There's a little bit more barriers that you have to overcome with investment if you are a trailblazer. But there can be a lot of great innovation that's out there. Now, if you're improving on a product that already exists, that's helpful because you can walk the path, you can do the research, you can understand the mistakes they've made, the things that didn't work, the things that did work, and really, learn from your competition. You can also, that helps you to really find and develop understanding and differentiation for your product as you begin to take it to market. The other thing I like about competitors is that, you have business advisors that you can leverage for different stages of the business. You can bring these individuals in as business advisors, befriend them. You don't have to give them all the answers. You have to give them a portion, but what you end up doing by doing that is a strategy. You end up spreading the love around. They get some options. You can, call on them, befriend them. They get to know who you are. They get to have you on the radar for what you're doing because those acquisition relationships take time to build. And you have now tied a potential competitor or acquirer to the success of your business. So if you're successful, they're successful. And so it's very much a strategy to think about on how you could really implement it and do this as you go forward into the market to really help get your business to the next level. The other thing about the competition slide that's really important to think about. One, I need logos. Once again, logos draw me in emotionally to what's going on. Think about it. You're in a store. You have a generic brand or you have a North Face brand. Which do you find more value in? Typically, it's North Face because they have a reputation. The logo connects you emotionally to what they have built and the type of product they have. So use those logos. I love quadrant slides and figuring out, the different axes and what they might be. The horizontal may be quality and maybe the vertical is price, however you want to do that. The thing about the quadrant is we read from left to right. And so because we read from left to right, our eyes track in certain ways. So if you end up putting your logo on the left-hand side of the screen, guess what? My eyes are going to track from left to right, and they're going to end on whatever logo is in the upper right-hand corner, which is why you always see company logos in the upper right-hand corner. So think about that. If the quadrant slide doesn't work for you and you have to do like a chart of different features that your product has compared to what's currently out there in the marketplace, Another thing I see entrepreneurs do often is they put their company at the bottom of the chart. Now, inherently, language happens in many different ways. By putting your company at the bottom of the chart, you're typically saying that you're last compared to everybody else that's up there. So, put yourself up at the top, and then do things like make sure color is really important in how we identify with pros and cons. So green is go, red is stop. So the slide is very clear and defined as you build this out. The other thing with competition that's really important that you are faced with overcoming is not just the niche marketplace that you're working in, it's the status quo. We as humans don't like to change. How are you going to overcome that? So include the status quo. There was a great business plan I read through a school competition once, and they created a bracelet to hide a key. And they brought up the competition, which was like 3 other bracelets that could hide keys. And I was like, but wait a second, like, what about using my pocket, or like using my purse, or like even putting it in my shoe? Whatever it might be to like hide my key while I'm doing something. Those things matter on how you're going to get people to adopt your product. So think about this slide. Spend some time here. It's really important because it ties to your exit slide. It's also really important because it shows me what you've learned out there in the marketplace, what you've learned from your competitors, and how you're actually going to go out there and be better at what you do. And you're going to be successful. And once again, deliver me an ROI. So from competition, we then move into financials. So, all right. So there was many years ago, there was a company that came through and it pitched and it got to financial projections, and they literally just had a hockey stick up on the screen. And all the investors laughed, ha, 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 that's super funny. It's just a hockey stick. But here's the thing, when the hockey stick isn't there, we worry. We need to see that. And once again, it ties back to the market and how you get to market, how you bring on different verticals at different times and scale your product and really be able to hit those milestones to deliver a return to me, the investor, and how you're going to achieve those. It shows how the use of funds at different points and maybe different capital raises that go into your financial projections will help spur that growth. Probably my biggest pet peeve on this slide is an entrepreneur who gets up and tells me that their financial projections are conservative. Okay, great, awesome. Your financial projections are conservative. What does that mean? How am I supposed to take that word? What are you trying to tell me by telling me they're conservative? Is it 1% of the market? Is it 5% of the market? Is it 20% of the market? What is it? So use real numbers. I really want to see what the growth is. I don't want to see a watered down version of what you can do. I want to see what you want to do and then how you talk about how you get there. It shows once again that you understand this business. It demonstrates competency. And sometimes the projections are outlandish, which is fine. Just be prepared to defend them in front of a group of investors. Now, let's go back to the other end of things. So you could either have a really big hockey stick, or maybe you're working through your financial projections and you're just not quite getting there. It's like the line is like, it starts to go up and then it kind of flattens out. All right. Now, this is a problem that happens. Not every company is meant to go raise capital from investors. They're just not. There's lots of different types of businesses out there. 99% of the businesses in the United States are small businesses. And so, as you think about this, as you build out your financial projections, as you think about pitching to investors, once again, the key thing is why are you doing this? Do you really want to sell your company? Is this what the exit strategy is? Is this what you're moving towards? Do you have the market to do that? If you don't, it's okay. There's lots of resources available out there to small businesses. Get an SBA loan. You could still take money in from friends and family and be able to then, pay them back in dividends later when, things go well. There's lots and lots of different types of companies. So as you're building out your financial projections, once again, be real about the numbers. Be real about the growth. And if it's not really showing those inflection points that would be interesting for an investor like me to get a good ROI on my investment, then maybe this isn't for you and this route isn't for you. And that's okay. But it's really important for you to think about that as you move through the process, because the ecosystem is as such that the investors, they make money back and then they stick it back into companies. If you're just sucking money from the ecosystem and have no plans on how to return it, guess what? That great company, you might have just taken dollars away from them. For what? So do think about that as you move through your fundraising strategy. All right, so then we get to the team. The most skipped over slide by entrepreneurs. I'm running out of time. This is my team. Let me get to my deal. Please, for all things good in this world, do not skip over this slide. I need to know who the team is. I need to know who you are and who your founders are and who the people that are there in place that are supporting you, that you've built to execute. Because once again, if you don't execute here, my investment goes to zero. So does yours. So you need to spend some time on the team. Why are they here? What are their specialties? How do they complement you? Where do they come from? Show logos, once again, from businesses that they may have worked at. Now, if you have two founders and one's from Amazon and one's from Microsoft, you better have some damn good business advisors that are there to support you, because I will be very honest and blunt. You have no idea what it is to run a company. You have lived cushy corporate life. You have a computer, a desk, a phone, all the amenities provided to you. That is not what building a company is. So you better have some good business advisors to back you up that you can leverage and you can gain advice and support from to help you through this journey, because it's really hard. And once again, it's not for the faint of heart. So how do you use your business advisors? Who are they? How do they support you in the company? How are they going to add those values to your business? And a board of directors. Now, the advisors are there on the business side to support you, the CEO, and the company and the growth. The board of directors is there to support me, the investor, and all the rest of the investors to make sure that the CEO is held accountable and the company is moving in the path it should be moving. There are some good books written by Brad Feld on choosing a board and raising venture capital that I would encourage you to read and move through. These things are important. Even as you start, you should have a board of directors, even if it's just you and the founder and someone outside of the business that may have expertise. You need support and help. It's a lonely road, and you need to be able to use them. But do not skip over this slide and once again, demonstrate and show how the team is going to be able to do this and execute upon what the plan is. All right, and then we get to the deal. So if you notice, as we move from the competition into the financials, the team is executing on the financials, so the team comes next. And then me as the investor, I'm investing in the team. So that's why the deal comes next. This slide is critically important. I need to understand your deal terms, what round it is, what the pre-money valuation is, and be prepared to defend your pre-money valuation in some respects, depending on what that is. Show me use of funds, what my dollars in this round is going to be used for. Usually in a nice pie graph is nice. I can see that really clearly in a pitch. But a few things you need to get figured out, because this slide is usually pretty short and sweet and simple. But everything that goes into it is not. First off, is all your paperwork done? This is a really important question to ask. I've had companies present where it's like they don't have paperwork at screening. And I'm like, oh, okay, great. So am I just writing you a personal check, or am I actually investing in a business? So, work with your counsel, make sure all the paperwork's done. As you work with your counsel, please leverage your business advisors. Your legal counsel and CPAs are great. They should not be your business advisors. They're very expensive and they're inherently risk adverse. They're also there just to support you. They're not there to support and make sure the deals are fair and balanced. There's usually a lot of deal terms within these documents that are very detrimental to investors that will kill your ability to fundraise. So leverage your business advisors, ask good questions of your counsel on why certain things are there, and read your term sheets. Understand how every single line impacts you and impacts the investor, because it's a long-term marriage typically, and you both need to be in it together. And it needs to not be lopsided one way or the other. It needs to be fair and balanced. So what are your deal terms and why are they? Now let's get into that for a minute. So I typically go back in my previous life before kids, I sold real estate. And so I never thought I would apply real estate to venture capital, but when it comes to the deal, I do, because I feel like people generally have looked at houses, bought houses, been in the market, are searching things online, perusing things. And so it's a good relating point. So I break them up into equity, which is buying a house, convertible notes, which is buying a condo, and a safe note, which is buying a condo conversion. And let me explain. So equity is gold for investors. You tie me in directly to your business. For me, it's the safest investment there is, really, because like a house, I get the land. I am tied directly to that deal. These are the types of deals I want. I don't want some nuanced thing where I'm like floating out into the trajectory here, trying to figure out where I lie with the business. I give you money, you give me stock in return. I am tied into the business. I have my little paper certificate. I'm here to support and help the best I can. And I am tied to the direct success of the business as it continues to move forward and accomplish its milestones. And then you have a convertible note, which is really a condo with a view. I call it a condo with a view because I'm still buying air. As a condo, I'm buying air. A convertible note is air. It's a promissory note of one day it's going to get converted into stock. But there's also some sweeteners in there. There's some interest, there's a maturation date, there's usually a discount that goes into the next round. So there's some things in there that make it a little sweeter for me, that I'm like, okay, well, I might consider a note. And then there's a safe note, which is basically one day, maybe, if you're lucky, I might end up actually converting this into equity. I might hit that milestone that triggers conversion, and you might get equity one day. I call this the ground floor condo conversion. The construction's kind of shoddy. It's easily broken into, and most of the time you don't get your money back on your investment. So that's the way I think about safe notes. Now, a couple of things here. How you strategize this is really important to how successful your company is. With a safe note, there's been a new instrument that's come out that's not a pre-money safe note, but a post-money safe note. So it really is a true bridge to your round. That is basically a conversion to equity. And if the company ends up not converting it and they keep raising money on that instrument, it actually ends up devaluing the company for you. So there's a little bit more protections built in there. One thing positive about safe notes is they are standardized. With convertible notes, they aren't standardized. They're a dime a dozen. There's some really nasty deal terms in there that are very negative for investors. Like, if I end up selling my business before this note converts, you get a 2x return on your investment. Well, if you end up exiting for a 15x return and I'm only going to get a 2x return, how is that fair and balanced? And so this is where understanding that the attorneys are there to support you, they're your client, they really could give a crap about the investors, and you need to make sure as the entrepreneur that your investors have fair, balanced deals as they're choosing to come into this. And then there's equity, and being able to just get the equity is honestly what we want at the end of the day. Other things you need to take into considerations with your deal terms is your cap table, which is the foundation for your business and really tells the story of your company, and how much safe notes and convertible notes can completely foobar your cap table and your ownership in the company. So as much as you can stick to, okay, I'm going to start with a note because it'll help me set valuation. I'll move into an equity round. Oh, I can't go into the next equity round because I just need this little bit more money to hit these milestones. And then I'll go into an equity round after this little bridge into a note. That math is pretty simple. When you have note upon note upon note upon note upon note upon note in your cap table, with debt carrying it down, with really no realized equity or interest, it can really mess things up. So please do keep that in mind as you think about your overall capitalization plan and fundraising strategy. You need to understand what you're doing inside and out, how much you raise from the very beginning, and the last round you're going to do, and how it's going to implicate you. So to think about that. Now, valuation. Valuation is something else that's pretty nuanced. Once again, leverage your business advisors. This is not for your CPA to talk to you about valuation, okay? This is not their role. It's for people who have been there, done that, and understand what you're working through in your deal. I will be very honest with you. The market determines value, just like real estate. So it's great. You can come to me from the Valley and be like, hey, yo, I got this awesome product. I'm building this hardware device. It's going to be great. It's going to help improve the way restaurants work. I'm working to fundraise to build out my MVP. I'm raising on a safe note with a pre-money at 10. Oh, okay. So, hi, Mr. Entrepreneur. You have no product. You have no revenue. You have really crappy deal terms and extremely high valuation because you've essentially done nothing with your business and you have no IP, but you want me to write you a check. Okay. I will tell you, there are 15 more entrepreneurs with better plans and strategies than that than you. I'm going to go ahead and move along. You got to keep the valuation realistic. I mean, truly. And sometimes when you look at it, the difference between 10 million and even 6 million is just little percentages on the cap table. And you're able to get the round in the bank and get back to doing what you do best, which is building your business. So how long do you want to be fundraising? Is it an ego thing and you just think you're worth this? Or do you have really qualified people that wants to put in at this, that have been professionally investing for a long time? You're able to bring in those dollars, bring in that expertise, stop fundraising and get back to building. You really have to weigh these options. I go back to real estate here with the high cost of overpricing your home. Think about it. You see this awesome house on the market in this great neighborhood where everything sells in a week. It's gone. And you're like, wow, look at this amazing house. The pictures are awesome. Oh, it's been on the market 6 months. What's wrong with it? Oh man, they must have bad pipes, or the neighbors must be awful, or there must be some dry rot in the roof. They must have had a leaky roof. Something seriously wrong with this house. No. There was probably nothing wrong with the house. They just overpriced the house from the get-go and it didn't sell. So the biggest way to quash your company and what you're building is to run out of cash. And when you run out of cash, you go out of business. So as you think about valuation, leverage those business advisors, be strategic about it, understanding that at the beginning, you're going to be worth a lot less until you really get that traction, that revenue, and be able to really grow and hit those milestones. When you get those valuation inflection points, it will get easier. So have some good strategies around that. All right, I'm done now with that one, which then gets me into exit. I invest in it. This is how I get my money back. This is how you win, entrepreneur. This is how you be able to reap the rewards from all of your hard work. I need to know how I get my money back and just have a defined strategy. It's really great if you get on and you're like, well, you know, I could be acquired, or I could go public, or I could provide dividends. You know what that tells me? You actually haven't thought about your exit strategy at all, and you have zero exit plan. You actually have no clue on how I am going to get my money back as an investor, which will help me write you off and move on to the next deal. I need an exit strategy from the beginning. You should be thinking about this. If you're going to be taking an outside capital, this is something that is critically important to know from the beginning. I need comps. What's going on in this industry? What's happening? Are things getting bought and gobbled up? You might not have all the numbers per se, because that is something that's not always public, but you'll be able to be like, hey, look, Google bought this company or that company. You know, all of these different things that you can really help to show that this is an interesting space that bigger companies are looking for solutions for. And the other thing that I alluded to back on the competition slide is relationships are key. So all throughout the growth of your business, you should be planting seeds. You should be searching those people out, letting people know what you're doing, planting those seeds, watering them occasionally. Hey, can I just send you an update, here and there, and let you know what's going on with the business? Really to help support that exit process later on, knowing that if you get a phone call in the middle of the night that says, hey, I'm going to buy your company, chances are is you're getting lowballed and it's not a deal. One buyer is no buyer. You need to, create some excitement and have some multiple buyers here. That's how you're going to get the best price for you and for your investors. One great way to do this is by maybe creating an exit board of advisors. Bring together a few CEOs who have exited their business before. Leverage them specifically on this topic. Learn from them. They've been in the trenches. Exit takes time, just like creation and ideation and growth. All of those different stages of the company life cycle, exit is another stage of the company life cycle. It takes 12 to 18 months to successfully exit a business. Whatever exit strategy you have, just have it defined, know what it is, and know it takes time. Also, the big thing to understand is on your growth trajectory, as you continue to grow your business, your exit process should start before you peak. Well, how the heck are you supposed to know that? Well, you're not. You're supposed to have an exit board of advisors, have a strategy and a plan built out, and be able to leverage different expertise to be able to see that. But if you start the exit process after you peak, typically what ends up happening is either you end up exiting far long after you should have peaked, you get less money for your business, it takes more time and resources, or you could just end up failing altogether and everybody loses everything. So this is really, really important to have a plan for this and understand it. And as you work through those longer conversations with those investors, being able to dive into what this is and how they can lend support to you as they have successfully exited companies themselves through their own portfolio. So after exit, we get to our last slide here, which is really traction, or what I like to call, I like to call it traction. Some people like to call it summary. This is the last thing the investors are going to hear before they fill out their interest sheet. It's an overview of all of your milestones. It's your customer reviews. It's any asks that you have beyond capital here. Like, keep in mind, we're looking to build out our team, complete your interest poll. I'm looking for due diligence team members, include your contact info on the slide, advertise here. Know that this slide will be up as you're talking, but I do want to encourage you to have a bunch of appendix slides and have your slides that are in your pitch. Your Q&A portion that you move into after this is more important than the pitch itself. It's where you demonstrate competency. It's where you show the investors that you understand your product, your space, and what you're building, your trials, your tribulations, and you're ready to go after it and get it. Use your entire deck as you move through the question portion of the session that you have with the investors. And know that this is meant to be an overview, 50,000 level foot, and the questions can definitely dive in deeper. So once again, just some key takeaways here. As I just said, your pitch is an overview. It's meant to generate interest. That's all it's meant to do. You're not going to raise money off of your pitch. You're going to raise money off of the subsequent calls of building relationships with investors and them getting to know you, understanding your business, understanding the trials and tribulations, and then finally making the choice to write you a check, because people invest in people they know and trust. As you move through and interview these investors, you should be interviewing them. So as much as they're diligencing you, you should be asking them questions like, how many companies have you invested in? How do you work with those companies? What kind of an investor are you? If you have any, red flags that kind of pop up, hey, do you have any references that I can talk to? These are people that you're getting married to essentially for at least 5 to 8 years. Let's be real. It's not 3 to 5. So get to know who they are. Know your audience before you reach out. I cannot tell you how many cold emails I get, how many reach outs I get on LinkedIn. A poor entrepreneur actually called me one night on a Friday at like 5:30, had no idea how we worked, how we fundraised, how I worked with my companies. And he got a full on earful from me. Just do your research. Don't waste my time. Don't waste your time. Know who you're reaching out to and at what time it's appropriate to reach out to them. If you have an idea for a company, I'm glad you're here today, but my organization is not fit for you yet. You need to start elsewhere first. So know that we're here to support, we're here to lend resources and to help, but pitching to my group is not the best fit. You need to do that down the road. Are your documents done? Do you understand those deal terms? We care about the solution. We're investing in the solution, not the problem. Stay out of the weeds. Don't dive into customer reviews and other things like that. Save that for Q&A. It just causes confusion. And once we get confused as investors, we start problem solving in our mind. And then you've lost us. We're not thinking about what you're saying anymore. We're thinking about what you just said and why you said that. We miss the presentation then. More pictures, less words. Know your capitalization plan. When you raise capital from beginning all the way to the end. If you're going to be returning capital to investors, you should have built that before you even start. And then is your exit strategy realistic? Be realistic about timing. Every single company that comes through says 3 to 5 years. I'm going to exit in 3 to 5 years. Do you know that we get to hear that as investors every single month and have for years? So be realistic about your timing. Is it really 3 to 5 years? What makes it 3 to 5 years? Can you quantify that in some sort of way? Or is it actually going to be, 8 to 10 years, which is what we've actually seen? We understand what we're getting into as early stage investors. We're very realistic about that. We need you to be realistic about your plan too. And finally, and probably most important, is just be coachable. We get you don't have all the answers. We get that you need help from us, and we're here to definitely help and support. So that is, in summary, my presentation training. And I'll leave you with this final quote: forget all the reasons why it won't work and believe in the one reason it will. So thank you for running the marathon and doing the things you do. We need innovation now more than ever. Thank you so much. Have a great day, everyone.